It is early July, and you walk into an office, and there on the desk is just a massive overflowing shoebox.
Oh, we've all seen that shoebox.
Right. It is just stuffed with faded thermal receipts, crumpled invoices, unopened bank statements, and there is this heavy, just palpable sense of dread hanging in the air.
Absolutely.
The business owner standing there looking at this mess, asking the accountant that one dreaded question, have I missed anything?
And usually they have.
Yeah. But here's the thing. Because today is Saturday, June 6th, 2026. And for small business owners in Australia, well, whether you can hear it or not, there is a massive, invisible clock loudly ticking in the background.
That ticking clock represents a very specific expiring window of opportunity.
Right.
What we're looking at is a situation where the failure to act before that clock strikes midnight on June 33rd, well, it results in real capital just evaporating from a business.
Which brings us to the core mission for this deep dive. We are looking at a pretty conservative estimate that the average Australian small business leaves about $7,000 on the table every single year.
Wow.
$7,000, just gone. And not because they were doing anything wrong or, because they weren't legally entitled to keep that money. It vanishes entirely due to bad timing.
And the scale of that loss across the entire economy is enormous.
Yeah.
But on an individual level, I mean, for the listener operating a small enterprise, that $7,000 is payroll.
Yeah, it's inventory.
Exactly. It's the safety buffer for a quiet month.
Yeah.
And the reason we are really analyzing this today is because that loss is almost entirely preventable.
To figure out how to stop that leak, we are pulling from a really comprehensive advisory briefing we've got here. It's from Trinity Accounting Practice over in Sydney.
Right.
It is a deep dive into 2026 end-of-financial year planning strategies. Now, just to set the parameters here right out of the gate, we aren't financial advisors.
No, we are not.
And we aren't giving personal tax advice today. The goal is to take this briefing, extract the absolute most urgent mechanics of how these tax laws work, and give you the tools to be proactive. Because, okay, let's unpack this. The end of financial year is not a vague guideline.
No, it is a hard stop.
Right.
The midnight deadline on June 30 is absolute.
Yeah.
I mean, once the calendar ticks over to July 1st, the financial reality of the previous 12 months is locked in a vault.
Yeah.
You cannot go back in and change the parameters of what happened. But before we explore the specific mechanics of, say, write-offs or superannuation clearinghouses, the Trinity briefing highlights a foundational shift in perspective.
A psychological hurdle, basically.
A psychological hurdle that prevents business owners from capturing that lost money.
You mean getting out of that panicked, that crime scene mentality with the shoebox of receipts?
That is exactly it. The
Yeah.
shoebox is just the symptom of the problem. The root cause is that most business owners treat tax time as something passive, like an event that happens to them after the year is over.
Right, like a weather event or something.
Exactly. But the briefing introduces a fantastic framework for changing this. They note that before June 30, your accountant is a strategist.
Okay.
But after June 30, they are merely a historian.
Oh, let's pause there because that metaphor does a lot of heavy lifting.
It really does.
When you walk in during late July with that box of receipts asking your accountant to save you money, you are essentially asking a historian to change the outcome of a war that ended weeks ago.
That's a great way to put it.
They can categorize the wreckage, right? They can tell you exactly how much you lost, but the events are set in stone.
Right, because a historian can only document the decisions you already made. They look at the artifacts, your receipts, your bank feeds, and they write the report.
Yeah.
A strategist, on the other hand, operates in the present tense. If you sit down with them in early June, well, they can look at your projected profits and tell you which levers to pull today to alter the final outcome.
So all the tangible financial value, like the actual tax savings, is generated right now in the few crucial weeks before June 30.
Entirely.
It completely flips the script. I mean, you aren't reporting on what happened. You are engineering what is about to happen.
Exactly.
And if we are engineering an outcome, the most massive lever sitting on the control panel right now, according to the source material, is the instant asset write-off.
Yes, definitely.
This is something that is facing a drastic legislated change in just a few weeks.
Yeah, the current state of play for this financial year, ending June 30, 2026, allows eligible small businesses to immediately write off the full business cost of an asset, provided that asset costs less than $20,000.
Okay, I want to clarify that word eligible for a second. The briefing mentions aggregated turnover. So if someone owns a little cafe doing $500,000 a year, but they also own, I don't know, a commercial cleaning company doing $12 million, how does the ATO look at that?
Right, so the Australian Taxation Office groups those connected entities together. They look at the combined or aggregated turnover of all your affiliated businesses.
So you can't just hide behind the cafe's revenue.
No, you cannot. If that total pushes past the $10 million threshold, you lose access to this specific small business concession entirely.
Got it. Assuming you are under the threshold, though, the power of this write-off is substantial. Normally, capital assets have to be depreciated over their useful life, right?
Yes.
So mechanically, what does that look like without the instant write-off? Like, if I buy a commercial coffee machine for $15,000, I don't just put that on my tax return as a $15,000 expense that day.
Under normal depreciation rules, no, you do not. The ATO says that coffee machine will last, say, 5 years.
Okay.
So they force you to spread the tax deduction over those 5 years. You might only get to deduct $3,000 this year, $3,000 next year, and so on.
Wow. Even though my cash left my bank account today.
Exactly. Your cash is gone today. But you're waiting half a decade to realize the full tax benefit.
Right.
The instant asset write-off bypasses that waiting period. You claim the entire $15,000 against your taxable income in the year you buy it.
Which keeps the cash flow inside the business right now when you actually need it.
Precisely.
And the briefing notes, this is a per asset limit, meaning you could buy 4 different items that each cost $19,000 and instantly write off every single one of them.
You could.
But here is the massive cliff we are approaching. On July 1st, 2026, this threshold doesn't just dip, it plummets.
Yes, it does. Unless there is last-minute government intervention,
Right.
which, as the briefing notes, you can never rely on for financial planning,
Okay.
the legislative threshold drops from $20,000 down to just $1,000.
That is a staggering difference.
It's huge.
A $19,000 piece of equipment goes from an instant deduction today to a 5-year mathematical headache next month. So seeing that cliff approaching, I mean, the immediate instinct might be to just go on a massive shopping spree. You know, go buy a new work truck, upgrade all the computers, just to crush the taxable income before the deadline.
Which is exactly the impulse the Trinity briefing warns against. They phrase it perfectly. Do not let the tax tail wag the commercial dog.
Okay, I love that. Let the tax tail wag the commercial dog.
You have to remember the fundamental math of a tax deduction. A deduction is a discount. It is not a refund.
Meaning, if I drop $18,000 on a new commercial oven for my bakery, the government isn't sending me an $18,000 check.
No, they are not. They are simply ignoring $18,000 of your profit when they calculate your tax bill.
Right.
If your company tax rate is, say, 25%, spending $18,000 might save you $4,500 in tax. But you still permanently parted ways with $13,500 of your own cash to buy the oven.
So if my bakery didn't actually need a new oven to generate more revenue, I just burn cash for the sake of a discount.
Exactly. You only utilize this strategy for assets the business fundamentally requires to operate and grow.
Okay, so the commercial logic has to come first. But let's assume the logic is sound. My bakery's oven is dying, I have the cash, and I actually need the upgrade. I go online on June 25, I buy an $18,000 oven, and the money leaves my account. The deduction is secured, right?
This is where so many business owners fall into what we can call the installation trap.
The installation trap.
Yes. Paying for the asset does not trigger the deduction. The tax law explicitly states the asset must be, quote, installed, ready for use, before the June 30 deadline.
Wait, really? Let's follow the physical reality of that. I ordered it on June 25. The invoice is paid. But the supplier has a warehouse delay, and the delivery truck doesn't roll up to my bakery until July 3. I am 3 days late.
The ATO does not care about the date in your receipt or the shipping delay.
Oh, wow.
Because the oven was not physically in your premises and capable of baking bread at midnight on June 30, you completely missed the window for this financial year.
And what makes that so brutal in 2026 is that the deduction doesn't just get neatly pushed to next year.
No, because next year...
The threshold has collapsed to $1,000.
Exactly. Because the delivery truck was 3 days late, your $18,000 oven no longer qualifies for the instant write-off at all.
Yeah.
You are suddenly stuck depreciating it over years.
That is terrifying.
It illustrates a fascinating contrast between our daily life and tax law. I mean, in everyday consumer life, the transaction ends when your credit card is approved.
Right. You get the dopamine hit, it's done.
But in commercial tax law, the transaction only matters when the utility of the item is realized. So if you need physical machinery or vehicles to lower your taxable income this year, ordering them in late June is a massive gamble. You have to plan with enough lead time to ensure physical operational delivery.
That delay with physical goods makes sense when you think about it. Trucks break down, warehouses get backed up. But let's look at how this illusion of speed traps people with digital transactions. We expect moving money online to be instant. Which leads us to the next strategy in the briefing, dealing with services and cash flow. It's the ability to legally pull next year's deductions into the current year.
The mechanism here is prepaying expenses. If you operate a small business entity, the law allows you to pay for upcoming operational services now, before June 30th, and claim the immediate tax deduction in the current year, provided the service period does not exceed 12 months.
We're talking about things you are going to be forced to pay for anyway, like your annual business insurance premiums, your software subscriptions, maybe your professional association memberships.
Yes, all of those.
So if you have the cash reserves, you pay the 12-month lump sum on, say, June 20, and you capture that deduction today instead of bleeding it out monthly over the next year.
It functions as a temporal lever for your cash flow.
Yeah.
But analyzing the why behind this strategy requires looking at your revenue projection.
Yeah.
Why would a business intentionally drain its cash reserves in June to pay for next November's rent?
Because they had a massive windfall this year and want to aggressively lower their current tax bill.
That is the primary reason. If this year was wildly profitable, you want to stack as many deductions into this year as possible to offset that high income.
Right.
However, if this year was terrible, but you just signed a massive contract that will make next year your most profitable year ever, prepaying expenses right now is a terrible idea.
Oh, because you are wasting the deduction in a year where your tax bill is already low.
Exactly.
Yeah.
You would want to save those deductions for next year to offset the upcoming windfall, so it requires a deliberate decision.
So it's a strategic forecasting game. You only get to use the deduction once, so you have to decide which year it serves you best.
Right.
But while prepaying insurance is an optional strategy, the briefing points out a digital payment trap involving something that is absolutely mandatory: employee superannuation.
Yes.
And with the super guarantee rate hitting 12%, we are talking about a significant chunk of change.
The sheer volume of capital moving through the superannuation system means the ATO scrutinizes these deductions heavily, and the timing mechanics here ruin a lot of well-intentioned businesses.
This is where that illusion of digital speed I mentioned really comes in. Let's say a business owner sits down at their computer on June 29. They log into their payroll software, they process the June quarter super for their staff, and the money vanishes from their business bank account that afternoon. In their mind, the bill is paid before June 30.
The critical misunderstanding there is the definition of paid.
Okay.
For tax purposes, an employee superannuation contribution is only deductible in the financial year that the funds are actually received by the employee's specific superfund.
Walk me through the mechanics of why that matters. The money left my account on the 29th, where is it?
Well, almost all modern businesses process these payments through a clearinghouse.
Right.
A clearinghouse is essentially a digital sorting facility. You send one lump sum payment to the clearinghouse, along with a data file detailing which employee gets what. The clearinghouse then takes that money, breaks it apart, and routes it to dozens of different super funds: Australian Super, Host Plus, self-managed funds.
Like a central mailroom sorting letters before they go out on the trucks.
Exactly, but a very slow mailroom. Clearinghouses routinely take 5 to 7 business days to process and deposit those funds. So if your money leaves your bank account on June 29, it is just sitting in the clearinghouse's holding account on June 30. It has not been received by the employee's fund.
So legally, it's just floating in the ether.
Yes, which means the deduction is entirely lost for the current financial year and pushes into the next.
Even though I paid it.
You fulfilled your legal obligation to your employees, meaning you won't get fined for late payment, but you completely missed the tax deduction for this year.
That is rough.
The Trinity briefing provides a hardened rule of thumb to avoid this. Allow a full week. If you want the tax benefit for this year, that super payment needs to be initiated by the 3rd week of June. The intention to pay means nothing. Only the cleared, finalized transaction counts.
The theme keeps coming back to the fact that reality is defined by when the paperwork clears, not when you push the button.
That's it, exactly.
Which perfectly sets up the next section of the briefing, because it pivots away from money actively leaving the bank, like buying ovens or prepaying rent. This is about deductions that are hiding in plain sight, money you already spent, or internal accounting moves that don't cost you $1 today.
These internal adjustments are where the historian versus strategist dynamic really shines. We can start with bad debts and obsolete stock.
Okay.
Every business has them, but very few properly crystallize them for tax purposes.
I want to understand the mechanism here. Let's say I did $10,000 of consulting work in February. I sent the invoice, it's now late June, and I just found out the client's company went into liquidation. I am never seeing that money. How do I actually turn that bad news into a tax deduction?
Well, the error most people make is simply leaving the unpaid invoice sitting in their accounting software, hoping for a miracle.
Just ignoring it.
Right. But to claim it as a tax deduction, you must officially write it off as a bad debt in your general ledger before June 30. You have to formally admit defeat on paper.
Because if I wait until August to tell my accountant the debt is dead,
Then it was technically still an active receivable on June 30, meaning you still owe tax on that phantom income.
you're paying tax on money you never received just because you didn't click the write-off button in time. That is brutal.
It is.
And I imagine it's the exact same logic for obsolete stock sitting in a warehouse. If I have $5,000 worth of electronics that are just outdated and unsellable, I can't just throw them in the dumpster in July and claim it for the previous year.
No, you cannot. You must perform a stock take, identify the worthless inventory, and officially scrap it from your system prior to year end. You are adjusting the mathematical reality of your business to match the physical reality.
Which brings us to the ultimate hidden deduction mixed-use expenses. Things like the mobile phone bill, the home internet, using the personal car for business trips. The briefing points out a huge behavioral flaw here, referring to it as the lazy tax.
The lazy tax. Yes, it occurs because apportioning a mixed-use expense feels tedious.
Yeah, nobody wants to do the math.
Right. A business owner looks at their monthly phone bill. They know they use it for client calls, but they also use it for personal reasons because they don't want to calculate the exact split or, because they fear an ATO audit. They either claim an arbitrarily tiny amount like 10% or they don't claim it at all.
They just give up the money to avoid the mental friction.
Exactly.
But the source material lays out the armor against the ATO here, and it's actually surprisingly simple. You don't have to track every single call for the rest of your life. You just need a logbook.
A logbook is the legal mechanism that transforms a vague estimate into a hardened, defensible deduction. The ATO generally requires you to track your actual usage, whether it's mileage in your car or the ratio of business-to-personal internet data for a representative period, typically 4 to 12 weeks, depending on the specific asset.
So you suffer through the tedium of logging every trip or every call for a month or two.
Yes.
But once you establish that baseline, say it proves your car is used 65% for business, you apply that 65% to all your fuel, registration, and insurance for the entire year.
That's right.
You build a fortress of paperwork once, and it protects your deductions for months.
It creates a verifiable audit trail. The ATO penalizes guesswork, but they respect documented methodology.
Speaking of heavily documented methodology, we have to tackle the most legally strict warning in the entire Trinity briefing.
The trusts.
Yes. This applies to anyone operating their business through a trust structure, which is incredibly common in Australia for asset protection.
It is very common. And the mechanics of a discretionary trust are unique. Misunderstanding them triggers devastating tax consequences. A trust is not a person or a company. It is a legal relationship. Think of a trust as a bucket that holds the profits of the business.
Okay, the business makes money, the water fills the bucket.
Exactly. But the trust itself does not want to pay tax on that water. If profit is still sitting in that bucket at midnight on June 30, the ATO penalizes the trust by taxing that money at the highest possible marginal tax rate.
Oh, wow.
To avoid that, the trustee must open the spigots at the bottom of the bucket and distribute all the profit out to the beneficiaries, usually family members or a corporate entity.
Right, because those beneficiaries will pay tax on that money at their own, usually much lower individual tax rates.
Precisely.
So the goal is to drain the bucket completely before the deadline. What is the paperwork trap here?
The trap is the trust distribution resolution. The trustee must legally resolve and document in writing exactly who is getting what percentage of the profit before June 30.
But wait, how do you know the exact dollar amount if the year isn't even over yet?
You don't. You don't need to know the final dollar amount because the accounting isn't finished. but you must establish the percentages.
Hmm.
For example, declaring that 50% goes to spouse A and 50% goes to a corporate beneficiary.
Ah, okay. And the briefing specifically calls out that the ATO aggressively hunts for backdated resolutions.
They do, because it is a massive area for tax manipulation. Historically, people would wait until October, figure out exactly how much profit the business made, look at everyone's individual tax brackets, and then draft a resolution splitting the money perfectly to minimize tax.
While pretending they made that decision in June.
Exactly.
But you can't fire up a time machine for paperwork. The legal decision has to exist in reality before the financial year closes. So if the ATO audits your trust and asks for the metadata on the digital document or proof of when that resolution was signed and they find out it was drafted in August, what happens?
The distribution is considered invalid. The profits are legally deemed to have stayed inside the trust bucket at midnight on June 30, and the ATO taxes the entire amount at the top marginal rate.
That is catastrophic for small business cash flow.
It truly is. Signing that piece of paper is the ultimate end of financial year housekeeping item.
It's amazing how all of these strategies, the asset write-offs, the prepayments, navigating the clearinghouses, the trust resolutions, none of this is aggressive tax evasion. We aren't talking about hiding money in offshore accounts.
Not at all. These are ordinary, legislated entitlements designed to stimulate the economy and help small businesses manage their cash flow. The government wants you to invest in that new oven. They want you to plan your superannuation properly.
The only variable separating the businesses that capture these entitlements from the businesses that lose that $7,000 a year is timing.
Yes.
It is entirely about being on the correct side of midnight.
Which brings us back to the primary call to action from the Trinity briefing. End of financial year cannot be a passive occurrence. You must make it a deliberate, diarized event. You need to sit down with your advisor in early June, which is right now, not late July. You must walk through this specific checklist, review your capital purchase lead times, calculate your prepayments, initiate your super clearinghouse transfers, document your bad debts, and sign your trust resolutions.
So as we wrap up this deep dive, consider the underlying architecture of what we've discussed today. We operate in a modern commercial world where we feel like things move at the speed of light. But the deeper you look into the legal framework of taxation, the more you realize how rigid it actually is.
It raises an important question for you to consider about the nature of your own operations. Consider how our entire financial system relies on the strict, arbitrary boundary of midnight on June 30.
It really is arbitrary.
It is, and it reveals a fascinating truth about modern commerce. In the eyes of the law, your financial reality isn't determined by your intentions, your effort, or even the money leaving your bank account. It is determined entirely by when the paperwork clears.
Wow.
Are you managing your business, or are you just managing the calendar?
Are you managing the business or the calendar? That is a great thought to end on. Because if the paperwork doesn't clear, well, that effort didn't happen. Think back to that crime scene metaphor we started with. The dark office, the desk covered in thermal receipts, the historian telling you what you missed.
A painful position to be in.
But you do not have to be that business owner. You have the time right now to step out of the wreckage and into the strategist's chair. Grab the calendar, understand the mechanics, and go get your plan sorted. Thanks for joining us on this deep dive.